Community. Last time we presented change of character and how to trade it. Today we are going to discuss about inducement. The meaning of inducement is a thing that persuades or influences someone to do something. If we are talking about persuading or influencing, what inducement does in trading is persuading traders to enter into the market. Then when inducement happens, their stops are taken out and price moves in the desired direction. The market participants were induced into making a bad decision by the market makers. The goal of market makers is to trade in the way that offers the least line of resistance. This inducement allows traders to get taken out and be on the wrong side of the market on both sides before the market makers make their moves. Market makers use your psychology against you. They know already that you are going to take a position based on FOMO, the fear of missing out. Therefore, they make a fake impulsive down move or up move just to get you involved in an early position and then turn you out. They will take your stop losses before continuing their final moves. So let's see figures of inducement to understand better this concept. In a bearish trend, we would like to see swing highs protected and swing lows broken. You may find inside the same bearish move two or many order blocks. These order blocks were created on purpose so you can take a short position earlier. In this example, at the level of the order block number 2, market makers made this impulsive down move in order to get you involved in a short position. Your stop loss is going to be set above the order block number 2 and you'll target the previous swing low, right? Once you enter in the market, you are trapped by market makers and you are a part of liquidity that will be grabbed later. Order block is much powerful every time liquidity has been left in any form. You have to be sure that liquidity has been created and taken before reaching your point of interest. It can take the form of visible liquidity, double top, double bottom, resistance, etc., or hidden liquidity, trend lines, swing lows, or swing highs. In this example, while the price was retracing back to the order block number 3, market makers were creating liquidity in form of this price range. So they took the buy-side liquidity first, reached the order block, then price dropped down impulsively to break the previous swing low. Let's move on now to a chart example to clear things for you. In this example we are using for our Nasdaq chart, we have a bearish order block that broke the market structure. Market makers created a resistance line on purpose to create buy-side liquidity. You can notice that price took the liquidity resting above these equal highs, get into the order block before taking a momentum bearish move. As you can notice here clearly, we have swing highs broken and swing lows protected. At the level of this first impulsive bullish move, we have left two order blocks, order block number 1 and order block number 2. The first one was actually inducement for people wanting to take a long position earlier. Price dropped down after that, took the sell side liquidity, reached the second order block below the first one, and then continued higher. Same scenario for the second impulsive move. Here, this time, liquidity took a form of a trend line created on purpose by market makers. They took the liquidity resting below and reacted after reaching the bullish third order block. Let's move on again to the chart to see some examples. In this example, we are using US 500 5-minute chart. After the extensive bullish move that made the break of structure, price retraced back in a descending channel pattern to accumulate retail positions. Price made a small fake bullish reaction with this green candle at the level of this order block before dropping lower to the lowest one. As smart money traders, we already know that liquidity has been left above this pattern, so we wait for inducement to happen before taking a long entry. In this example, we are using 30-minute Nasdaq chart. We have two bullish order blocks. Market makers mitigate this second order block first and created a support line on purpose to create sell-side liquidity. Price showed this green candle as a fake bullish reaction. After taking the sell-side liquidity, price reached the first order block and made this bullish reaction. Same scenario is happening in this example, but this time we are using daily Nasdaq chart. Market makers, after mitigating this second order block, they created equal lows to generate sell-side liquidity. After reaching the first order block, price went higher. So let's see an example of a trade using the inducement. Here we are using the 1-minute Nasdaq chart. As you can see here, price is bullish. First, we broke this structure here, formed this fair value gap, traded back to fill it and start trading higher again. So price is showing us a bullish momentum. So let's see what will happen here. So here price made a retracement back to this bullish 1-minute order block here. Normally, you'll see that price is starting to trade higher once it reached this bullish order block. So maybe you'll think about taking a long position here and put your stop loss below the order block. So let's see what will happen next. So as you can see here, price traded lower. Here, price made this bullish move at the level of this bullish order block just to induce traders so that they'll take a long position here. After that, it will trade lower to take their stop loss. As you can see here, there is a fair value gap here that hasn't been filled yet. So the price, after creating the inducement, traded lower to fill this fair value gap. So as an institutional trader, we'll take a long entry. We'll wait for a small change of character to happen here and the price to fill this fair value gap before taking our long entry. So here I'll put a long position. I put my stop loss below the order block, and for the target, I'll target this buy side liquidity level here. So after making this retracement and breaking the structure again, I'll place my stop loss to break even. And my target is hit.